So they can defer the tax as long as they want. As long as they continue doing 1031s, they can defer that taxes all the way out until.
Hi everyone, Jonathan Martis here with North Pacific Real Estate. I'm a local real estate broker in the greater Seattle area, and today I'm interviewing Paul Van Every. He is a 1031 exchange facilitator, and we wanted to talk a little bit more about 1031 exchanges. He is with IPX 1031 out of Bellevue, Washington, and he helps many clients regarding 1031 exchanges. Now, this is a topic that a lot of people may have heard of, maybe some landlords or investors, but we wanted to kind of learn a lot more about it from a professional who deals with this on a day-to-day basis. So, Paul, thank you so much for joining us on this podcast, and for our viewers. If you want to just introduce yourself, kind of say a little bit about you and just some of your experience with 1031 exchanges, that'd be great.
Absolutely. Well, thanks for having me, Jonathan. Excited to be here. So as you mentioned, I'm with IPX 1031 Exchange. We are a qualified intermediary. We are throughout the country. My main territory is the Washington and actually the Pacific Northwest market. That's where I cover. I've been doing exchanges for 12 plus years in various roles between management and sales. And so I definitely have seen lots of exchanges, lots of changes over the time, and definitely love to help clients get through the process of 1031 exchange.
Awesome. Thank you for that intro. Can you briefly just kind of give an overview of what it is and why people should be aware of it?
Absolutely. So 1031 exchange is a great tool for you to be able to defer your taxes on an investment property. It's a great vehicle to transfer wealth and to grow your wealth. So it is something that we use and see happen quite a bit. Again, it's mainly used for investment property. And so that is a great way to either diversify your portfolio, grow your portfolio, or eventually also opportunities to buy your dream home.
Yeah, for sure. No, it's something I've come across as an agent, of course. There are people who want to take advantage of this. And although I know quite a bit about 1031 exchanges, I don't know in depth as much like you do, because you're the professional, and that's why I wanted to have you on today. 1031 exchanges it's a way to defer taxes, right? So some people might think, oh, they never have to pay the tax on a 1031 exchange. So how far out can someone defer the taxes on a property? Let's say that they buy and they're renting it out for years and they decide to sell it, and then they want to invest in a different property. So how many years can they defer the tax, and how does it work when they purchase a property and rent out, and then when they're ready to sell the property and get their next one as an investment? What are some of the guidelines and how far out they can defer the tax?
Absolutely. So they can defer the tax as long as they want. As long as they continue doing 1031s, they can defer that taxes all the way out until death. At the way things are set up currently, there's what's called the step up in basis. So it is actually something that happens quite often right now. It's a great planning tool. It's a great estate planning tool to do 1031s, because people can defer their taxes on a 1031 exchange. They could eventually pass that property on to their heirs, and those taxes all go away at that point. Because with the step up in basis currently, if you inherit a property that has been done in a 1031 exchange over the years, you'll inherit it at today's fair market value, and you could sell it the next day and not have to pay any taxes. So there's no limit to how many times you can 1031 exchange. But what happens is the moment you don't 1031 exchange an investment property, so if you've been doing 1031 exchanges over the years, now you decide to just sell and pay taxes, that's when you'll have to pay capital gains going all the way back to your starting point of the first property you exchanged.
I see.
Yeah.
So it's once they actually make a profit, in essence, right? They're cashing out and they're taking the money, putting it into their bank account, and they're selling it off. Then they pay the capital gains tax, which is what it would be, correct? The federal?
Correct. At that point, that's when the taxes go back. And again, it goes back to your starting point, to your original basis of that first property you bought. So if you brought a property in 1990 for $100,000 and you exchanged all these years and you now sell your property for $1 million, you're going to go back to that $100,000 basis and have to pay taxes. So
Okay, so you wouldn't pay on the new value of the, because you know what, some people that I speak to, some landlords, or I talk to them and I say, oh, would you be interested in selling your property, and then deferring the tax and moving up into like kind of increasing your asset value into a property that's
Mhm.
more expensive? Because when you sell and take advantage of the 1031 exchange, it has to be at a higher value, correct? So if somebody buys a property at 100,000 and then they sell and they want to buy another property, it has to be higher than what they originally purchased the property for.
Correct. So some of the basics of the exchange. In order to make it a fully tax deferred exchange, you'll want to buy something equal or greater in value than the property you sold. So as you mentioned, if you sell for $100,000, you want to buy something at least $100,000 or greater. That'll make it fully tax deferred. Any cash that comes out of that sale transaction needs to be reinvested into the new property. So you can't take any cash out in a 1031 exchange. It
Mm-hmm.
all needs to be reinvested into the new property. At that point, that makes it fully tax deferred. Now, with that being said, if you decided to take some cash or if you decided to buy down in value, it's not going to affect the exchange because I get that question quite often. I get the question,
Yeah.
"Hey, I bought a property or I'm selling this property for $1 million. I really don't want to spend $1 million on a new property. Can I do an exchange for less value?" Yes, you can. You can do exchange for less value. Just be aware the difference is taxable. So, like, you use the example: if you sell for $1 million, you buy something new for 800,000. You have a $200,000 difference. That's taxable. So, it doesn't stop you from doing an exchange. It just will have a tax consequence if you buy down in value, as well
Okay.
as if you take some. It's not uh, prohibited from taking cash. So if you say, "Hey, I want to keep $100,000 to give to my family, or just use for myself," you can take $100,000 in cash from the transaction. It's just taxable, that
Yeah.
amount. Does
Because
that
that's a gain at that point that you're putting into your
correct?
account or
So that,
cashing out on.
that's it's a term that we call boot. That's boot out of the transaction, and that boot is taxable. Uh,
Okay.
so we get those questions quite often. Some of the
Yeah.
misconceptions on 1031 is, I'm selling this property. I only want to reinvest the cash that came out of the transaction. So again, that doesn't work. You've got to buy equal or greater in value and use all the cash. You can't just buy with the equity.
Yeah, so what you sold it for, not what you bought it for. So if you bought it for 100,000,
Yeah,
you sold it for 200,000, you have to buy a property that's greater than 200,000 to fully defer all the tax again, correct?
yeah, yeah, exactly. And so what our role is on the process is we're going to talk to those clients and we're going to educate them on, what their best strategy is, whether or not buying down makes sense because some people want to buy down so much it really doesn't benefit them to do a 1031. So we're going to go over all that with them. We're going to go through the process step by step on how it works, and we're going to make sure they feel very comfortable going into the exchange. That, hey, I understand it, and I know that this transaction is going to be, it's going to be honored and valued, and it's going to be valid according to the IRS.
Perfect. Thank you for that. So a qualified intermediary, can you explain what that
Mhm.
is and why it's needed?
Absolutely. So, in order to qualify for a 1031 exchange, there needs to be an intermediary involved, and that's where we come into play. What we are is a third party. The reason being there needs to be an intermediary involved is that the client cannot receive the funds. So you can't just have a sale transaction where escrow closes and sends the money to a client. They have the money and then they go and buy. That doesn't qualify for a 1031. There has to be proper documentation set up, which we prepare, and the money has to come to us, the intermediary, and held in a bank account separate from the client. So we create a bank account that's in the client's name. It's under their tax ID number. So it's a separate segregated account, but they can't have access to that account. We have to
Hmm.
control those funds. The reason being, it states very clearly that the client can't be in receipt of the funds, nor can they control the funds. Because if they do, that voids the 1031 exchange. So we hold those funds when they're ready to buy their replacement property. We work with the escrow team and we then release those funds at closing. So it's very important that we are in place before you close escrow. It's also very important you choose wisely when you're choosing your intermediaries. You want to choose an intermediary like IPX that has a strong background. We are owned by Fidelity National Financial, so we have a strong background. We are secure. Fidelity's been in business for over 150 years. We're not going anywhere, so your funds are
Yeah.
safe. We put them in a FDIC insured bank account. We make sure the funds are in solid banks that are, again, segregated account under your name. Washington State has some requirements. One of those is that it's our fiduciary responsibility to make sure we are placing your funds in a very uh, low risk account. And so you may not earn a ton of interest while it's with us, but
Hmm.
at least you know when it's time to buy your property, the money will be there and the purchase will be made.
No, that's great. Thank you so much for that explanation. Um, Something I wanted to ask is for like multiple properties, right? Let's say somebody has a house, they bought it for, I'm in Seattle, right? Properties are more expensive in our area, but let's say they bought it for 500,000 a few years ago, and now let's just say it's worth 1.5 million, for example's sake. Can they buy multiple properties, and does it have to only be one? I know you can buy multiple properties. I just kind of want to ask certain questions that people
Yeah.
might be thinking is how many can they buy? What are the limits? And what are the rules regarding that? Can they buy some condos instead of just
Sure.
one house, even though collectively it's going to be
Yeah.
worth more? How does that work?
Absolutely. So, to answer your first question, yes, you can absolutely buy multiple properties. You can buy as many properties as you want. But at the end of the day, the limiting factor on that is is the identification rules. So you can buy multiple properties, not a problem. You can choose to buy, and also to answer your question, you can choose to buy any type of real estate as long as it's investment real estate. So you
Okay.
can sell a single family property and you can buy a strip mall. You can sell a office building and you can buy a single family home. Again, the key is it's got to be investment property. You can sell vacant land, which we see a lot happening where, hey, it's not producing much income. You've got some vacant land. You maybe thought you were going to build on it one day. It's just not going to happen. You can sell that and turn that into a multifamily. You can turn that into, any sort of investment real estate. But the key is it's got to be investment property. Now, going back to how many properties you can buy, the limiting factor is the IRS gave some guidelines that state you can either identify three properties, any value, and you can choose to buy one, two, or all three of those. So that's the most common ID form rule we see. So during what happens is when you close escrow, you have 45 days to identify a replacement property. So not only do you have 45 days to identify that replacement property, you're given the rules of you can either choose three properties, again, any value of of those properties, and you can choose to buy one, two, or all three. The second rule that we commonly see used is called the 200% rule. Now, this would be in a situation where a client wants to buy obviously more than three properties. In that scenario, you can identify up to 200% of the value of the property you sold. So if you sold for $1 million, you can identify up to $2 million in properties. So you could identify 10 $200,000 properties. And then you could buy all those 10 properties and you're in compliance. Um, we see that happen again when clients are choosing to buy more than three properties. And that's again what we'll do is when we have a conversation with the client, we'll ask, what's your end goal? What are you looking to
Yeah.
accomplish? Are you looking to buy one property? Are you looking to buy multiple properties? Because this way we can help them with what identification form they're going to need and how they're going to need to identify. And we also then, like I mentioned, you have 45 days to identify. We're going to get that ID form back and we're going to review it to make sure it all looks good so that it's all, again, in compliance. And we're going to put it in the file. If we have any questions, we're going to reach out to the client and say, hey, let's clarify this.
They would
So
send
this
you
is our
those addresses, right? Like if they're identifying the
correct.
properties, these buyers would be in touch with you. They do
Correct.
they would they send them to me and to you just so that we're on the same page? Because I mean, I'm assuming from
Yeah,
time to time you're collaborating with the real estate broker.
absolutely. We're always collaborating with the real estate brokers. We always want to make sure we're keeping you in the loop when we have conversations with the clients so that everyone is on the same page. It's obviously it's a team effort. We want to make sure that everyone is on the same page and working together and
Yeah.
there's no confusion happening. It's always good. So I'm sure what happens is usually they're working with you, and they're identifying properties they may be interested in buying. Then they're
Hmm.
providing those property addresses to us because we need to get the full address. It can't just be,
Yeah.
oh, I'm looking at 123 Main Street. Um, you know, we need to have specific addresses. And the reason I guess the IRS put this in place is they don't want people to just say, I'm identifying every single property in Bellevue, Washington
Mm-hmm.
as my replacement. They wanted you to be specific. And so, yes, again, we'll work with you. If we have questions, sometimes depending on the client, some clients want to go to us to go to them directly. Some want
Yeah.
us to work through you. It really is how the client wants it set up, and we're gonna follow their instructions.
Perfect. How does it work in a situation where, during COVID, the market was really crazy, properties going on the market and then going off the market in 2 days. So if someone's wanting to do a 1031 exchange, let's say the market gets, hot like that again, how would it go with identifying the three properties? And just curious to see how it was when you went through that time with 1031 exchanges.
Yeah, I mean, obviously that becomes a lot tougher. What happens, you become a little bit more limited on what your options are. During that time, we had a lot more people that were, because properties were selling so fast, they were able to kind of identify their replacement property before or simultaneous with putting their property on the market.
Mm-hmm.
And things were happening so fast, they were able to accomplish it. Um, a lot of it is planning. A lot of it is just being prepared for what the expectations are. Like I mentioned, the 45 days, understanding what that is. Now you can change your identification up to the 45th day. So once you get to the 45th day, now you're locked in. So you can be making changes to those properties. You can be making adjustments. Once you reach the 45th day, now you're locked. Now those are the properties you have to purchase. Um,
Hmm.
but what I would
Okay.
say is a lot of the most successful people and the most successful exchanges we had were prepared. They didn't go in either uneducated on the transaction process or not knowing what was available potentially for them as a replacement property. They did their due diligence prior to starting their exchange. They did their research on the market prior to doing their exchange. So they worked closely with their realtors and understood what they were getting into.
Mm-hmm.
Unfortunately, we get a lot of people who are literally going to the closing table and they see how much they're going to pay in taxes and they go, wait a minute, I don't want to pay that much. What are my options?
Yeah.
We're getting a call day of setting up an exchange. Those are going to be tough. Those are going to be tough to accomplish, and you may be buying something you really don't want. But if you're going in with a good plan and you know what's available to you, um, a lot of times we see a successful and happy client.
Awesome. No, that makes a lot of sense. Um, Quick question I have for you. I have some questions here. Wanted to
Mhm.
go through. So, what is the time frame for someone who wants to? Let's say they're renting out their property. They're a landlord. They're renting out their property for 6 months. How long do they have to wait before they decide, or they're allowed to take advantage of a 1031 exchange? They weren't planning on doing a
Absolutely.
1031 exchange, but they've been renting it for 6 months. Maybe they want to sell and they want to take advantage of the tax benefits. What are the rules regarding that on the time frames on how long
Yeah,
they have to wait?
absolutely. So this is one of those gray areas in 1031. There's not really a black and white set number. Okay, so some tax advisors will say 12 months is sufficient. Some will say 18 months, or sorry, 24 months is required. So, really, in that scenario, it's going to be up to the client and the tax advisor to feel what they suggest or to get what their recommendation is. But
Yeah.
again, this is a gray area. There's nothing set in stone that says you have to hold it this long. There's also obviously extenuating circumstances, reasons why you might need to sell that property, why you might need to do a change. All these things need to be discussed with their tax advisor and kind of vetted out to make sure that it makes sense that they're going to qualify for the 1031.
Okay. To be on the safe side, how long should someone wait before
Safe
they?
side, yeah. Safe side is 24 months. Safe
Okay.
side is at least two tax returns that show, hey,
Renting it out currently, or let's say 6 months of that 2 years they were trying to rent it out. Because I have heard that they need to try to rent out the
yeah,
property as long as that's the goal.
absolutely. I mean, the goal is that they were trying to rent it and it was an investment property. So if they have proof that, hey, I listed the property, I just wasn't getting it, at the price I wanted. Um, these are all things that you want to have uh, prepared in case of an audit.
And that's
The
why they
worst
should
case
reach
scenario.
out to you to go over all these things first, right? If they're thinking about a 1031 exchange, or landlords that I
Absolutely.
speak to sometimes, if they're considering it, the best starting point for them would be to reach out to you to get things going, so that once they get to that
Right.
point where they want to sell, they're not trying to rush everything last minute and they're ready to go. I could help them find properties, identify properties, so that everything's going smoothly. Is that the best way to go about it?
That is absolutely the best way. What we're here for is to identify if there's going to be any red flags. We're going to identify what their end goal is, and so we're going to be able to help educate them, walk them through it, and make sure they understand what they're getting into and what could be a potential issue ahead of them. And then again, we're going to circle back, talk with you, and say, "Hey, I had a great conversation with your client. This is the situation." So we're all again on the same page. We all understand what the process is. We all understand what they're trying to accomplish.
Yeah, perfect. Okay, that's great. What about someone who owns their house? They're living in their house, and they're like, you know what? I've heard about this 1031 exchange program, but I'm living in the house. But then after 2 years, if it's their primary residence, they can take advantage of the federal tax write-off, $250,000 gain for single, and
Yeah.
then $500,000 for married filed jointly. Um,
Right.
how does that work? And have you had any clients that do that? So if somebody lives
Right.
in the house, they want to take advantage of the 1031 exchange. Obviously, I think they can only choose one or the other, right? They can't have the federal write off when they sell, and they can't do the 1031 exchange deferred. They have to pick one.
Well, that's actually not true. There is a
Oh,
way that you can take advantage of both tax codes. So
interesting.
as you mentioned, if somebody's lived in their house for 2 of the last 5 years,
Mm-hmm.
it qualifies for their primary. But if they move out after 2 years and they rent it, once they've rented it for 2 years, now they've got qualification for the 1031. So it allows them to take advantage of both. They're still under the 2 out of the 5 years they've lived in it, and now they've rented it for 2 years. Now it qualifies for both the 1031 and 121 exchange, or sorry, 121 exclusion. So it is an opportunity for them to take advantage of both tax codes. So
How would that
again, an
work? How would that
example.
work like if they're selling, right? Because you get the tax write off. Let's say there's a gain of married filed jointly. You can write off $500,000 in profit, right? Federal tax gain. Um, and they make $600,000 profit. How would that work
Right.
with the 500,000 plus the 1031 to put that into
Yeah.
another property?
So you can take that $500,000 exclusion, no problem, and then the remaining amount is what would be the gain that you can exchange.
Okay, got
So
it.
yeah. So what they
That
kind
makes
of look
sense.
at is, yeah. So that 100,000 is now what you can take and do a 1031 with. Now in this scenario, you don't have to buy equal or greater than the final sales price.
Hmm.
You actually will only have to buy the gain when it became a investment property.
Paul, there's a way that people can actually use a 1031 exchange for a vacation home. And I think a lot of people would be interested in learning more about that. Can you speak a little more about how that works?
Yeah, absolutely. There is opportunity for you to be able to buy a vacation home that doesn't need to be permanently rented. It can be rented and used again, as their vacation. It can't be their second home, but it can be used as a vacation home. And what that is,
Mm.
you can buy a property, an investment property, and it can be rented as a vacation. It needs to be rented at least 14 days per calendar year after you acquire it. So
That can
if
be on
you acquire a
Airbnb,
property,
VRBO, or any of these. It
correct,
doesn't have to be like
correct,
a certain process, just as long as it's being rented out for a vacation home to others.
correct. Correct. For 14 days per calendar year. So if you buy a property in 2023, I'm sorry, 2024 now.
Yeah, we're in
Buy a property in
2024.
20,
Crazy.
we buy a property in 2024, you rent it out for 14 days in 2024, and you rent it out for 14 days in 2025, it qualifies as a vacation home. And you can use that
Mm.
property for personal use up to 14 days per calendar year as well. So it is an opportunity to use that property for personal use during the calendar year.
What happens with the remaining time? So maybe I missed something. So you have to rent it out for 14 days. So let's say I buy a property in Florida and I'm
Sure.
renting it out for at least
Yep.
14 days of the year on Airbnb. And then I stay
Yep.
there. I have to stay there at least 14 days, or is that the maximum?
So yeah, you can use it for personal use, but the maximum amount of time you can use it is 14 days. That is one of the IRS rules on a vacation home. So if you exceed the 14 days, it could be an issue. Now, if you rent it more than 14 days, let's say you rent it for 200 days out of the year, there's actually in the rule you says then you can use it for 10% of the time. So if you rent it for 200 days, then that actually ups the amount of time you can use it for personal use. So if you cross over that 14 days and you start getting into more and more days, if you again use it as a rental for many more days than 14, that potentially increases the amount of time you can use it for personal use. If you were asking, earlier what can be done with the property, um, you can rent it as long as you want as a vacation home. You can, rent it almost all year as a vacation home. And then that again, if you reach over again 200 days, rent it for the year, you can now use it for 10% of the time that you rented it. So that means you can use it for 20 days. So um, there is advantages to renting it more. It's also a great advantage that you only have to rent it for 14 days. That property gets very little use and it starts qualifying for a 1031 exchange.
Thank you so much, Paul, for that explanation. I wanted to ask you about Delaware statutory trusts. I've heard about these. A client of mine has taken advantage of this. Can you elaborate a little bit more about what that is and what are some of the benefits of using a DST, as they call them, a 1031 DST?
Absolutely. Yeah, absolutely. So Delaware statutory trusts have become more and more popular over the last 5 to 7 years, I would say. What a Delaware statutory trust is it's a opportunity to buy into larger properties as a percentage owner. So it is a trustee that manages the property. So you don't manage the property, but you are buying in. So it offers you opportunities to buy into multifamily properties, office properties, medical buildings. A
Mm.
lot of DST providers have many different property types that you can invest into. Uh, Similar to almost like a mutual fund, right? You can
Yeah.
diversify your money into different property types. The benefits of those is um, what we call a mailbox check, where it's a mailbox property where you just go to the mailbox and pick up your check every month. You
Hmm.
don't have to manage the property anymore. You're not responsible for the property. You are just receiving income off that property on a monthly basis.
Interesting. So you get paid usually on a monthly basis based on how much equity the property has grown, or if it's being leased out, or how does it work with the monthly pay?
Yeah,
Because
and
usually with
every
the
DST is different.
property you sell it, then you take the gain and
Yeah,
defer it into a different property.
right.
The
So
yeah.
you can get a monthly dividend on the property. It all depends on how you set it up with the DST provider. It could be an annual return. Every DSTM provider, has different options for the client. There's even options I do know that, it is a benefit to some clients because they don't have to take a new loan. Um,
Mm.
so the way it's structured is you don't have to take a new loan, which it qualifies still for the 1031, and it helps people who might be in a fixed income situation find a great tool to still earn income without getting a new loan.
I see. And are there some people that just invest in something like that right away, or is it what you see people that have properties
Yeah,
that they've been selling and then defer the taxes?
yeah. I mean, I see it more so people that have owned properties for a long time who are tired of the management situation or tired
Yeah.
of, dealing with tenants, that type of situation.
Because that would be my
Obviously,
hesitation, to
that
be honest, is if I were to buy properties and invest in properties, there's a lot of advantages. But this can be an option where it's kind of a hands-off approach, right? You invest the gain from the property that you sold, and then you just kind of put it into a DST, and it's a
yeah,
little bit easier to not have to worry about so many aspects, correct?
absolutely. It's a less management heavy. Now, some of the negatives you're tied in to sometimes 5 to 7 years, depending on the
So
investment.
there's minimum
And
terms.
yeah, and also when they sell, you have to make a decision. If they sell a building, am I staying in and going to the new building, or am I cashing out and now have to do another exchange?
I
So there's
see.
a lot of variables that have to be decided. I
Yeah.
do see it, as I mentioned, as an avenue for people who are kind of doing estate planning. Maybe they
Hmm.
have multiple family members that aren't going to want to manage property anymore. So when
Yeah.
they do inherit those properties, they don't want to have to. The heirs are saying, "Hey, I don't want to manage property," and
Hmm.
so this might be a great vehicle to put some money into, or if they want to, help provide income down the line, that's a great opportunity. Um, I also see it as good opportunities if maybe you're not able to find a property equal or greater in value, and there's leftover money that you can take some of that leftover money and put it into a DST so that it makes it a fully tax deferred exchange.
So if somebody doesn't identify a property within that 45 days, or they can't close on the property because they have to identify the property or properties within 45 days after closing,
So
and they have to close 180 days after the their property closes, correct?
correct. So even you have to still identify during the 45 days the
Mm-hmm.
DST, but if you're during a identification period, you're only finding, so during that 45 days, if you're not finding a property you really like that's equal or greater in value, and you know you're going to be buying and you know you're going to have some leftover money, but you don't want to pay taxes, you can engage a DST provider pretty quickly, and they usually have available properties that you can invest into. And sometimes, you might have a leftover $100,000, $200,000 that you can put
Mm-hmm.
into the DST. So it's a great way if you know, hey, I can't find a property that I truly like that's equal or greater. It's a great way if you have leftover money and you don't want to pay taxes to put that additional funds into a DST.
Okay, and what's a typical turnaround time? You said it could be done pretty quickly for a DST from when they start.
Yeah, really quickly. I mean, DST providers, a lot of times they're going to have available properties they can get into right away. So if we can engage with them and get it turned around right away.
Perfect. And by reaching out to you, Paul, you can help facilitate, what some so who they can contact to kind of get going on some properties, or
Abs-
you have resources for that.
Yeah, we have, many DST providers we work with. Um, we're going to recommend they reach out to a few of them to see who they're most comfortable working with.
Yeah,
It's obviously the client's decision at the end of the day, who they feel most comfortable, who they think is the best fit for them. So we want to give them options
yeah.
that they can do their research on.
Perfect. Okay, is there anything else, Paul, that you think our listeners should be aware of that maybe about 1031s that we haven't spoken about, maybe something we may have missed?
Yeah, I mean, I think just some of the basic things. One of the big things is vesting in a property. So how title is held in a property is very important in a 1031 exchange.
Yeah.
This comes into play more so when you have partnerships.
Hmm.
If any client or if anybody out there is in a partnership and they're thinking about doing a 1031 exchange, it's really important to do prior planning, because if that partnership wants to break up and go their own way, that can create a problem. So vesting issues is a big thing. So how you hold title in escrow, how the taxpayer is, I'm sorry, how you hold title and who is the tax paying entity needs to be the same on the purchase. So that's a big piece, vesting. And again, when we have our conversations, we're going to go over that. It's usually more common in commercial properties, but we do see a lot of residential properties that have partnership, because they bought together and they formed an LLC um, for either lending purposes or safety purposes. So something to be aware of is the vesting. Um, that's one big thing, and as well, um, just knowing what your opportunities are, what you can buy into, and what you can do with the property. If you're ever selling an investment property, my recommendation is contact me, contact a qualified intermediary to see if a 1031 is the right way to go, because you
Yeah.
you may not realize there's some benefits and there's some
Hmm.
opportunities that could be out there for you. The last thing I would say, um, again, make sure you're working with a reputable 1031 in this environment with this market. You want to make sure you're going with somebody that's safe, secure, and that your money is going to be there when you need to make that purchase.
Yeah, most definitely. Paul, thank you so much. This was a great interview. It helped me to learn more about 1031s and definitely can help me when I advise my clients, especially on who to contact. And for me, for those that are watching, if you're looking to purchase a property for a 1031, or if you have a property you want to sell, just reach out to me. My information will be linked in the description and also on the screen here as well. And I will also show Paul's information so you can reach out to him, and his information will be linked in the description also. So reach out to either of us if you'd like to get started with a 1031 exchange, or if you just want to find out more information about the process, and we'll definitely help you out with that. Paul, thank you so much again. All the best to you, and I'm sure we'll be working together as the years go by.
Absolutely. Thanks, Jonathan. Appreciate it.